And this is basically how I became the FTMO all-time record holder for the biggest prop firm in the world. This is the strategy that I use. There's no secret behind it. All right, ladies and gentlemen, welcome to today's episode. My name is Bernd Skorupinski, and this episode is sponsored by FX Pesa. Let me quickly introduce myself before we jump into the charts. My name is Bernd. I'm a full-time trader with more than 12 years of experience. I'm trading multi-assets, forex, futures, and stocks. I'm actually the FTMO all-time record holder. FTMO is the biggest prop firm in this world, and I'm holding the record with more than 120 leaderboard appearances in less than 1.5 years. I'm a prop trader as well, and I'm funded $4 million in prop firm capital. And I'm also the CEO of a licensed investment consultancy in Dubai that is regulated by the UAE government. In today's video, I'll show you a little bit of my trading strategy, and I'll show you how I get fundamentally biased in a market. I actually use a two-step mechanical process in my strategy. The first step is getting fundamentally biased, bullish, bearish, or neutral. If I'm neutral to a market, I'm staying away. I don't have an edge. But if I'm bullish or bearish, then I go to my step 2 of my two-step mechanical process, where I use technicals to time the market. In today's video, what we're going to cover, I'll show you one tool that I use to get fundamentally biased. All right, let's jump into the charts. Now, what you see here, first of all, I'm using TradeStation to analyze my charts, but you can use any other software as well. You could use, for instance, TradingView. What is important here, I'm going to show you how I use the COT data. So what is the COT data? Just briefly, you can do your due diligence yourself, but I'm at the official website of the CFTC. That's the Commodity Futures Trading Commission. So the COT report, the Commitment of Traders report, basically what you're going to do is here, you have 3 parties in that in that COT report that have to report their weekly numbers, their weekly volumes, what they are trading on a weekly basis. They have to officially, by law in the US, report those numbers. And there are 3 parties in that COT report. They are the retail traders, they are the non-commercials, which are the big hedge funds in this world, and they are the commercial traders, which are the producers, the users and producers. So we will predominantly now focus on 2 parties. We will focus on the commercials, which I consider the smart money, and we will focus on the retail traders. And I've displayed here already the COT indicator here for the retail traders. By the way, this indicator is not a secret. It's not only available to me. You have this indicator available online. You just have to Google COT indicator, and then you will find it. For sure, you can also display it on TradingView. It's very important the way how you display it, ladies and gentlemen. You have to go to the futures chart. The symbol usually is at GC. And it's on the weekly chart only. Why? Because this data, as I mentioned before, is only getting published once a week by the CFTC. Again, this is official legal data, very important. And so futures data, and then you have to find the COT data. This is split into 3 groups. And so the retail traders, the smart money, which is the commercials, and the commercials, users, producers, basically. And then we have the hedge funds. So we will not focus on the hedge funds in this analysis. We will focus on 2 parties, the commercials and the retail traders. And I want to show you something really interesting. And I want to teach you actually how to get financially biased in that market. Now we'll speak gold, and for that, here is the weekly gold chart on top, and on the bottom here I have the COT data for the retail traders. For this exercise, what I'm going to do is I'm going to hide the charts in a way, so just to see what happens if the CUT indicator. So I'm going to backtest with you basically together. And what I'm going to showcase is that the chart is behaving based on what in this case, the retailers are doing. And actually, I want to showcase that the chart is behaving the opposite way of what the retailers are doing. In other words, in my books, in my rule book, the retailers are always on the wrong side of the trade. This is one of the biggest lessons, ladies and gentlemen. You have to understand that the retail traders most of the times are on the wrong side of the trade. So for us, this tool is really great because we can see, hey, if the retailers are super bullish, well, then we definitely don't want to be bullish. We want to be bearish. And if the retailers are bearish, we want to be bullish. We want to always do the opposite of what the retail trader is doing. And I'll show you that how this looks like. Now, you see basically how this chart, this graph here is moving and is having these spikes to the upside and to the downside. And what I wanna showcase you now, because I already know obviously right now how the retailers are moving, or how they're behaving, and I have already a bias in that market, but I want to show you right now what happens if the retailers are extremely bullish in that market. Meaning, you see basically once that line is spiking up, this means the retailers are particularly bullish. But once these lines are down here, spiking down, dropping, this is basically when the retailers are super bearish, right? And we are focusing not on something that is somewhere in the middle here. We are focused on the big spikes up and down, because then we know the retailers are in an extreme. And by the way, this is also important to mention that this is not the retailers being biased. These are their actual positions in the market, in the futures market, because as I said, this is official futures data. So now we start at the current price, right? And I put like these vertical lines here just to showcase what is going to happen. Now, this is the current price. Now, we go back, and we want to see the spikes to the upside, because we want to see, hey, what happens to the chart if the retailers are super bullish? Look at this. So what we want to know is actually, we don't want to only see the spikes. We want to know that, we want to see how the retail traders behave compared to their previous behavior. So we analyze this data in a way that, hey, we check how the retail traders are behaving compared to their previous behavior. It's not only important that we see spikes. Well, these spikes mean that they're changing their behavior in the market, obviously drastically, but also we want to see basically how do they behave compared to their previous behavior. Did they change a lot? And if we look at here, for instance, and we're starting just here, and I'll put a vertical line here. You see that here in December, right? We see that here, in January, 12th of January, we see here that the retail traders are extremely bullish. And I move down with my mouse here, extremely bullish compared to their previous behavior. Here they were bearish, and now they spiked up. They were extremely bullish. All right, that's what we are looking at, the comparison to their previous behavior. Now, here you see another spike. So obviously that spike indicates that they shifted their bias, their position in the market place. Here they are also bullish compared to their previous behavior. Look at this here as well. Here they are bullish compared to the previous behavior. Obviously now here they are super bearish, right? We could check what happens when they are super bearish, because here they are dropping from super bullish to super bearish. But here you see how they are bullish again. And I put here again the vertical line, and see what happens compared to their previous behavior. We could also here somewhere put it here, but it's basically here we have 3 spikes. So this is where they're starting to be like super bullish. You see it basically here as well. They're bullish compared to their previous behavior. We have it here as well compared to their previous. You see, you have all these incredible spikes, retail spikes. And we could do this, like we could go all the way back. Now I'm backtest this for 10 years or so. And we would always, you will see, we would always see somehow a different behavior of the retail traders. Always, you see, always when I see that spike of retail behavior as well here, obviously, right? Big spikes. Look at this. I'm going back already to 2018, right? So now let's see. Let's open up that chart and make it a little bit bigger. And let's see what the chart, how the chart is behaving, how gold is behaving if the retail traders are bullish compared to their previous behavior. Remember, if you open up that CUT index, that CUT indicator, you always want to check, hey, how does this party, in this case the retail traders, behave compared to their previous behavior? Where do you see these spikes? Up, then they're super bullish. Down, then they're super bearish. And we want to act accordingly. So we want to be always on the opposite side. So look at this here. Now remember, ladies and gentlemen, this is a weekly chart. Here in beginning of 2014, once they were super bullish, look at this, red weekly candles, 3 of them all the way down. Look at this here in 2023. Here, super bullish, price dropped. Here as well, look at this, price dropped. Look at this here. Look at this here even. It was in 2022 in March. Look at this, we made a top, a big top here on gold, and look how price dropped as well. Here as well. Look at this here as well. Here as well. Here as well. Big red candle. And here as well. So we could basically look at this every time we see red candles starting to happen here. Whenever we see the retailers being extremely bullish in gold, we see the market is starting to drop. And now, ladies and gentlemen, I want to show you, now it's important, okay, we know already, okay, hey, when the retailers are bullish, the market is about to drop. But what's happening right now? Look at this. We are at the same level, basically, almost, than in beginning of 2024. And not only that, it's not only important that we are on the same level. Look where we are coming from. We're coming from bearish to now super bullish. So now this is our first fundamental bias where we would say, all right, the retailers are super bullish, so now we get biased bearish. Now I removed that tool here because we have already basically, one of our rule is met here, one of our fundamental rule is met, that the retailers are super bullish, so we are getting bearish. Now what else is important? Now I removed that retail data here from the CUT index. I'm going to open now at studies the users and producers, the commercials. So the commercials in this case is the smart money. All right, so that's the smart money, and we obviously we want to follow the smart money. We don't want to trade against the smart money. This is really, really important. So we want to trade against the retailers, and we want to trade with the smart money. And we do basically now the same exercise. I will not hide the chart right now, but we will do basically now the same exercise where we look at this data from a point of view where we want to see, okay, we know the retailers are already bullish. Now we want to obviously see the smart money on the other side. We don't want to see the smart money bullish because then we have contradictive data and we don't have any bias. So we want to see always the commercials on the other side of the trade compared to the retail traders. Now, since the retail traders are bullish, I want to see the smart money bearish. Again, same methodology. We follow the same methodology. We put first the vertical line to where they are right now. And now we don't want to see the spike up. We want to see a drop. And we want to see not only an extreme drop, we want to see, okay, yes, extreme drop. And then this basically relates to, or we can say this means that when we see a big drop in that data, that they are, compared to their previous behavior, they're turning very bearish, right? So imagine when they're turning very bullish, then obviously we should get bullish as well. But in this case, we are looking at the data in a way that we want to see now that if they are very bearish compared to their previous behavior. And look at this here. Here they were very bearish, right? The bottom here, and they were coming from very bullish. And look what's happening. Price here is dropping. Now, here as well and here as well. Look at this here. They are bearish compared to their previous behavior. Price is dropping. This is a weekly chart, ladies and gentlemen. These are, if you time that market and later on a daily chart, on a 4-hour chart, 60-minute chart, or depending on where you trade, this is a big move. Look here, they're bullish, and compared to their previous behavior, they are super bearish. Here as well, look at this, compared to their previous behavior, they are very bearish. Now, obviously, look at this. Here they were extremely bullish, right? Compared to their previous behavior. Look what happened. Here we made the bottom of all bottoms, and we never looked back, because look at this, how bullish we were compared to the previous behavior. But here, look at this, very bearish compared to their previous behavior, and price is dropping. And look at this, we can look at these, you see basically these spikes just by yourself at some point of time. You see here bearish. Even here they are bearish compared. You see always, it's always important compared to the previous behavior, how price is reacting. So again, we went all the way back to 2021. We could do this exercise, like we could go back test 10 years back, and you would always see the same thing. Once they are very bearish compared to their previous behavior, then obviously price is going to drop, which I just proved to you based on that backtesting data. And once they're very bullish, price is going to rise. I just showed it to you as well. Again, that CUT data is available on a lot of platforms. You can do your due diligence. You can do the research as well. And then it's just important that because it's only available on a weekly chart, and it has to be futures data, because this is official futures data. Now, what we have seen is basically, we have seen the retail traders are super bullish, tick in the box. We have seen the smart money, the users, producers, so the commercials are bearish, tick in the box. So we have a clear fundamental bias. We are definitely not neutral to that market. We are definitely not neutral to that market, because we have a clear fundamental bias. We are definitely not bullish, because obviously the retailers are bullish and the smart money is bearish. So we are actually bearish in that market now. That's our bias. Now, since we are biased, now we can go to our step 2. Now we can time the market. And timing the market, ladies and gentlemen, we can do with basically, well, any technical tool that you want to do. I use usually supply and demand. I sprinkle in some price action as well. But whatever you use, support, resistance, supply and demand, price action, you name it, you can do basically almost anything in terms of timing the market. What is important when you time the market, obviously, is that you have a set in place, an entry, a stop loss, and a target. So for now, I would say, if we look at gold prices here, obviously we are in an uptrend, but this doesn't mean anything, because we see now the smart money is bearish and the retailers are bullish. So for me now, this is the end of the bend for now, at least, right? So now I would say technicals, you see basically here is a very nice, so in terms of supply and demand, here would be a very nice, well, rally base drop, and you would basically have this as a zone for itself, right? This would be a supply zone. And by the way, I do basic supply and demand coaching on my YouTube channel that you can find, Bernd Skorupinski. I do a lot of this kind of content on my YouTube channel as well. You can just see how, if you have never heard about supply and demand, I have a basic strategy course about supply and demand on my YouTube channel as well. So this is a zone basically that I would say, hey, that's a supply zone. If price comes into that zone, I would expect, this is a daily chart, ladies and gentlemen, where I would expect price to turn. Now, there's a little bit more to it. Obviously, I would like to show you quickly, because we have here a gap. So I expect you to be a little bit advanced if you watch this and trying to understand this. You see from that candle here, from that candle here to that candle, there's a gap here. The close and the opening, there is a price gap. So since there is a price gap, what I would do here is I would expect that price gap to be filled. So that's how I can basically make my zone a little bit smaller. But since this is the high, I would also put my stop loss just above pivot. So it's also always important for me that I put my stop loss above pivots. So now in terms of, again, for any market timing tool, when you use technicals, you need an entry. Entry we just defined based on that supply zone basically, but also stop loss and targets. Well, I would use very mechanical rules here as well, because you have to be mechanical when you do trading, right? And very objective. So for me, very objective rules are when you place your stop loss, we just use this as a stop loss. I use 33% of my zone size as a stop loss. Very mechanical, very straightforward, always the same, right? So 30% of my zone is my stop loss. You see just here basically, I just can have my own rules here on TradeStation that I can just easily display these numbers. So 33% of my zone. Plus on top, then target. So from a target point of view, it's always important, if you ask me, to have like a risk to reward ratio of at least 1:2, if not 1:3, right? So now you see, now 1:1 means basically now it's including my stop loss. So this is now my entire risk here basically. So now if I would like to say, okay, this is my risk, I make this red. If I make this red here, this is my risk here on that trade. All right, this is my risk. And I would always look for, me personally at least, a risk to reward ratio, as I said, at 1:2. You see here, this would be 1:1. And all the way down here, this would be a 1:2. So that would be my minimum target. This 1:2 would be my minimum target, ladies and gentlemen. Now, and based on that 1:2 risk to reward ratio, you could even do 1:3 here. I would even say on this trade, we have a potential of a 1:4, but not exaggerate right now. Let's do like minimum target 1:2. Now it really depends. This is how you calculate your position size. When you say I risk $100, I risk $50, I risk $10, whatever you want to risk. So if you risk a $50 on that zone, right, then your price target would be down here and your profit potential would be $100. And if you risk $100, profit potential would be like $200. Just basic risk to reward calculation. All right, ladies and gentlemen, that's basically it. Again, to summarize quickly for everyone, we look at fundamentals first. Two-step approach, two-step mechanical approach. We look at fundamentals first. Here, I would recommend you to look at the COT data. It has to be a weekly chart. It has to be on the futures chart. And then you look at two out of three parties in that COT report. You look at the retail behavior and you look at the smart money behavior. And once you do that, you want to see how they behave compared to their previous behavior. All right, always check how they behave compared to their previous behavior. And if you have a confluence, so retailers bearish and smart money bullish, or the other way around, in this case we have the retailers super bullish, the smart money super bearish, then we get fundamentally biased, and then accordingly we time the market in our step 2 with our technicals. Very simple, very objective, very mechanical, and this is basically how I became the FTMO all-time record holder for the biggest prop firm in the world. This is the strategy that I use. There's no secret behind it. All right, guys, I hope you found value in that analysis. If you want more content like this, and if you have even questions, please comment below, and I'm happy to answer, and I'm very happy to provide more content. Thank you so much. Have a good day.